The headlines this weekend were a lot, and you can already see the markets are getting jittery. So, we're going to cut right through all that noise and focus on what these events in the Middle East actually mean for your money.
Okay, let's just dive right in. The whole point of this isn't to add to the alarm, it's to bring some clarity. As the source material puts it so well, you deserve a clear-headed take, and that's exactly what we're going to do. So, first things first, let's get grounded in the facts. What were the key events that kicked all of this off?
It all started Saturday. U.S. and Israeli strikes led to the death of Iran's supreme leader. Now, Iran didn't wait. They retaliated pretty quickly against cities in the Gulf. And that set off this chain reaction, right? Airlines immediately started canceling flights. And, this is the big one, oil tankers just stopped dead in the water near the Strait of Hormuz. They halted their transit completely.
As you can imagine, that rapid sequence of events triggered an immediate and honestly pretty predictable reaction from the financial world. So let's look at exactly how the markets responded.
The first and most obvious shockwave hit the oil markets. I mean, boom. Prices shot up a full 10%, hitting around $80 a barrel almost overnight. This is what happens when markets start pricing in geopolitical risk. It's the fear of what might happen to supply down the line.
And at the very same time, we saw this classic flight to safety. Investors started pulling their money out and piling it into gold, which is always seen as this stable, safe haven. That pushed the price up to a staggering $5,390 an ounce.
And here's why that oil shock was so intense. A full 20%. Think about that, 1/5 of the entire world's daily oil supply moves through the Strait of Hormuz. With that critical choke point basically frozen, the potential for a massive disruption is, well, it's very real.
So this brings us to the main problem the markets are wrestling with right this second, just sheer uncertainty. They're essentially trying to figure out which of two very different paths we're headed down.
So on one hand, you have the best case scenario, right? Diplomacy works, Iran's new leadership decides to be pragmatic, and this whole thing just becomes a bad weekend in the history books as markets get back to normal. But then there's the flip side, the worst case, a long, drawn-out conflict. If that strait stays clogged, you could see oil spike way past $100 a barrel, and that really starts to increase the risk of a global recession.
But it's usually not one extreme or the other. The source material actually suggests a more likely middle ground. This base case scenario expects a pretty short conflict, some partial de-escalation, and oil prices settling back into that $70 to $80 range by the end of the month. Now, looking at all these scenarios, especially the worst case one, it can be pretty unsettling. And that feeling, that anxiety, often leads investors right into a classic behavioral trap, panic selling.
I mean, this quote just nails it, doesn't it? When you react out of fear, you think you're protecting yourself, but you're actually doing the opposite. You end up selling at the absolute bottom. You lock in your losses, and then you just have to sit and watch from the sidelines as the market recovers without you.
And listen, this isn't some ancient history lesson. Just think back to the market lows when COVID first hit, or the interest rate shock of 2022, or even last April's tariff sell-off. In every single one of those cases, the people who panicked and sold regretted it because the market recovered and they were left behind.
Okay, so if hitting the panic button and selling everything is the wrong move, what's the right one? What are the smart, level-headed things you can actually do right now? The source gives us a really simple 3-step plan. First, check your cash. Seriously, having 3 to 6 months of your living expenses in savings gives you the power to just ride out the storm. Second, practice patience. This one is huge. If your long-term plan was solid last Friday, it's still solid today. It doesn't need emergency surgery. And third, be ready. For anyone who has capital on the sidelines, these moments of widespread fear have historically been the absolute best times to invest.
All right, let's zoom out one last time. When you feel that urge, that knot in your stomach telling you to react to the scary headlines, it helps to just anchor yourself with a much, much longer-term perspective.
Just think about what the financial markets have already survived. We're talking 2 world wars, the entire Cold War, the shock of 9/11, the 2008 global financial crisis, and the COVID pandemic. This current crisis, as serious as it feels, exists within that incredibly resilient history.
And if you remember just one number from all of this, please make it this one. If you look at every possible 30-year period going all the way back to 1928, the absolute worst average annual return you could have gotten from the S&P 500, and that includes the Great Depression, was still a positive 8%. That's the crucial takeaway. Time is the greatest antidote to fear.
So ultimately, we're left with this one critical question. We know for a fact that fear is not an investment strategy, so the only question that's left is, can patience be yours? Thanks for joining this explainer.